Hey, good day, everyone. Bert Salazar here. When it comes to retirement distribution planning, when it comes to preparation in order to continue a successful retirement life, there are a lot of issues and concerns that need to be addressed. One of the things that we try to do at Cambridge for each and every one of our retiree clients, it's we want to simplify in order to multiply. And the reason why we want to simplify in order to multiply is because we want our clients to have a very simple and very efficient financial life, yet we want them to have a very, very exciting retirement. See, as a retiree, you don't want to have to start thinking about your retirement distribution planning. Everything should be on autopilot. Everything should be done for you. Everything should be seamless when it comes to your retirement distribution planning and to mitigating all of the issues and concerns that you and your family may have in retirement. One of the things that we use with many of our clients is called the 3-bucket scenario, or the 3-bucket exercise, in which we look at the 3 buckets from 2 different perspectives. Number 1, from a longevity planning point of view, and number 2, from a taxable point of view. So let me go ahead and share my screen with all of you so I can quickly discuss with you the 3-bucket scenario, which I think you will find quite appealing and interesting from a business perspective. So as you can see there, you have the 3 buckets, bucket 1, 2, and 3. And from a longevity point of view, we consider those to be the go-go years, the slow-go years, and the no-go years. The first bucket is by far the go-go years. When people retire, they're healthy. They have been planning for retirement for a long, long time. They have all kinds of goals and objectives. So they're going to start doing a lot of traveling. They're going to be doing a tremendous amount of traveling because they want to see the world and they want to see things that they couldn't see while they were working toward retirement. Now, obviously, in the go-go years, you're going to be spending just as much money in the go-go years as you did prior to retirement. So the assets that you're going to have in that particular bucket may be totally different than some of the other buckets in the other 2 buckets. Now, the go-go years usually run from the ages of 65 to about 75. Although it can change. It depends on the health condition of the individual that is retiring or the family that may be retiring. It also depends on the year that you retire. I have clients that have retired at the age of 55. They're public employees. So the go-go years for them may be 20 years in length, where traditional employees in the United States and executives may have a shorter go-go year of maybe 10 years or so. Now, once you hit the mid-70s, you go into the second bucket, which is the slow-go years, which is normally between the ages of 65 and 75. And the reason why we call that the slow-go years is because, you may not be traveling as much. You may not be as healthy as you were during the go-go years. You may want to stay closer to home. You may want to stay closer to your grandchildren. You may want to do things for a charitable organization. So therefore, you're going to be spending more time at home, and life is going to catch on, and life is going to get in the way, and things are going to start to slow down for you and your family. Now, once you get into the third bucket, which is the no-go years, now you're into your mid-80s. Most of the people that are retired that I know that are in their mid-80s, they're staying very close to home. They very seldom travel, or if they do, is primarily short distances and time. They want to be closer to one another. They want to enjoy whatever number of years they may have left. Obviously, for most Americans, your health is not going to be at the same level that it was during the go-go years and the slow-go years. So there, is where you're going to start to find challenges where now healthcare may be a bigger concern. The expenses in healthcare may be a lot higher than they were prior to the previous 2 decades. So those are the type of issues and concerns that we discuss with our clients in how to divide their assets, how to create longevity protection for them and for their surviving spouses and family members and so forth. So there's a lot of planning that has to be done between the go-go years, the slow-go years, and the no-go years. Now, the next way that we use the 3-bucket scenario is from a taxable standpoint. You have the first bucket, which is your taxable bucket. Then you have the second bucket, which is your tax-deferred bucket. And last but not least would be the third bucket, which is your tax-free bucket. What's interesting to note, just about every client that we engage for the first time, we find that the vast majority of their assets are located either in the taxable bucket or the tax-deferred bucket. Very, very few clients have been able to totally maximize the tax-free bucket in retirement. Now, what goes into the taxable bucket? Well, you know, primarily your money market funds, your mutual funds, your savings accounts, your CDs, investments are non-qualified in nature, whereby every single year you're going to be receiving a 1099 and you're going to have to receive and report the income in the taxable bucket to the IRS every single year and pay taxes on the growth of that bucket. Now, the tax-deferred bucket is a little bit different. Most of you, I would argue, understand the tax-deferred bucket quite well because the tax-deferred bucket is your qualified plan bucket. There you're going to have your 401ks. You're going to have your IRAs, your 403bs, your pension income, anything that was contributed to on a pre-tax basis that has grown tax deferred and now you are ready to distribute, you're going to have to pay taxes on the whole thing upon distribution out of the tax deferred bucket. Interesting note, the vast majority of our clients, when we do tax planning for them, we actually discover that they're paying more taxes than they really need to. And the reason for that is that the vast majority of their assets are located in the taxable bucket and the tax deferred bucket. Now, the tax-free income bucket has certain products that are there for a reason and for a purpose. So for instance, in the tax-free bucket, you're going to have your municipal bond funds, which are federal income tax-free. You're going to have your Roth IRAs, your Roth 401ks that are also federal income tax-free in retirement. And last but not least, you're going to have your 7702 plans, which are also tax-free in retirement. Now, when you take a look at the 3 buckets from a taxable standpoint, and knowing what is happening today, and knowing what's going to happen in the future from a taxable standpoint, the one major question that you need to ask yourself and your family in retirement is, are your taxes going to be lower, the same, or higher in the future? There's a very, very high probability that unless you have been a financial failure for your entire life, your taxes are going to be a lot greater in the future than they are today. Why? Well, the national debt is sitting at $21 trillion and counting. The unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt is exceeding $114 trillion today. And what does unfunded liability means? It means that these are promises that the US government has made to each and every one of us, all Americans, that they don't have the money to pay for today. And the only way they're going to be able to pay for this mess is to raise revenues in the future. So ultimately, if you have a choice in retirement of where you would want the vast majority of your assets, Do you think you would want them in the taxable bucket, in the tax deferred bucket, or in the tax-free bucket? You see, at the end of the day, my number one goal and that of my firm with all of you is to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thank you so much for giving me a few minutes of your time, and we'll talk very soon.